Little presentation here. So with Fridays, I try periodically to discuss kind of an educational topic. We've been hitting some educational points throughout the days here, just as long as market volatility provides ample signals and strategies to talk about. Today, based on popular vote, we're going to talk about sector and stock rotation, which is an important topic. The general outline of sector rotation kind of gets blown up when the link between stock market and economy goes away, which I think over the last 5 years you can make that claim that the stock market is not necessarily moving with any sort of link to the economy or global economy. There's other forces at work to keep the stock market propped up. So we'll talk about that, and we'll also talk about, like Ron mentioned, a couple of what have been some longer dated trends that have lasted. As an example, an investor's quest for yield over the last several years, and how that trend is starting to show some cracks in the foundation. And when that trade does start to falter, what's the opposite? What's the other side of the trade that has been suffering for the last few years that's just getting ready to start warming up. So we'll talk about things like that too. But out of all this, guys, it depends on your time frame. And if you normally delve in short-term time frames, you can probably head off for an early lunch, because this won't matter as much. And a lot of the times where there's a bigger sector rotation going on outside of the day-to-day movements of stocks, if you're a short-term swing trader, you just notice that based on what stocks are outperforming on the day or on the week, and that's where you generally tend to focus. So whether it's intentional that you go because you're seeing a rotation happen or not, the stocks that are moving are generally going to be the ones that you want to trade anyways if you're trading in short-term time frames. So real quick, here's our objectives. So we're going to review the general business cycle and sector correlation. So when you're in kind of the early stages of economic expansion, when you're in the beginning stages of economic contraction, what sectors are generally outperforming, holding up better? Where is the money navigating towards in those types of conditions? We'll also discuss the psychology behind market cycles, and you guys know I'm all about average Joe and the fact that average Joe is so super predictable, and most market movements are. So we'll talk about market psychology during those expansion phases and those contraction phases. Most importantly out of all this, we'll review stock rotation within a sector movement. So let's say if there's a big rotation going on over into material stocks right now, how do you know which ones to buy first? And then after you buy those, how do you know which ones to look at next? It's like the big movement into home builders yesterday. How can you effectively pick the stock that's going to lead and perform the best initially? Take some profits on that. How do you know when that leader is going to stall and the laggards are going to pick up? What's the next stock to go? What's the pecking order of stock selection and risk appetite? I think that's probably the most important thing you got to know, especially if you're a short-term trader, if you're a stock picker. That's the meat and potatoes of being a stock picker. And that's why we're able to effectively do that as often as we are. All right, so with that being said, let's move to the next chart here. So this is assuming markets and economy are linked, which, hey, economic activity, you'll see that as economic activity picks up, and this is what's been different about the market rally here recently. During the last breakout, what was the group to kind of lead us in this most recent market rally? Who would you guys say that picked up and really pushed ahead to lead the S&P to new highs? And this is a group that hasn't participated. Yeah, banks, financials. So out of every single market rally over the last 5 years, the financials have been laggards. Stocks would go to new highs, banks would not. If everything broke out, if it was a really wildly correlated breakout, as soon as the markets would lift, banks would pull back. So this most recent leg of this rally is interesting because it's different, and it has been financials. You know, it has started with financials, and that's why I think the trajectory this time around has been so powerful and it's been so lasting, is that the banks, you know, really made up for a lot of this rally. And I'm in a sarcastic way, I'm saying that lately there is not a link between, you know, economic activity and stock market activity. Although I think there's a little bit of pricing going in that is going to improve right now. So think of where we are in terms of what's happening right here, right now, today. You know, one of the most underowned and underinvested sectors is really outperforming here recently. And let me show you what I'm talking about here. Let's go. I'm going to bring up a comparison chart here real quick, if you guys don't mind. Oops. Four, five, six, seven. And let me bring this chart over right now. So I'm looking at just kind of a general 1 year comparison against all, you know, 9 S&P sectors, along with the S&P as well. So the S&P is running right down here in the middle of the pack, and this is over a 1 year time horizon. So again, as you change this to shorter durations, this is going to mix up the tone quite a bit. But if you look at number 1 leading the pack, it's the XLF financials. So if you're of the, you know, secular opinion in the markets, and you think that the markets still have still a tremendous amount of upside in that theory, then what you see going on here with the XLF now finally pushing and leading is actually a pretty good signal. Let's shorten this up a little bit. Let's take it down to 6 months, and then I want to get to 1 month so I can help you see recent changes. So you can see that the lineup changes significantly, and the banks, which were kind of top tier here, are no longer at the top of the pack. When you run through some of these here recently, discretionary is the best performer over the duration, 6 months, which was, you know, as we looked at. I'll go back to the slides here for just a moment. Seeing discretionary, you know, to be the the second out of the performing groups on the way up through bull market conditions. Over a 6 month duration, they've been the one that's outperformed. You know, so that pretty much makes sense. And then right behind it has been healthcare. Healthcare, then banks, and then you get into the S&P, and then you've got all these laggards like technology, like materials. You know, materials and energy are the worst 2 performing out of the last 6 months. Let's change the time frame here yet again. Let's go 3 months. All right, and here it is again. Again, slightly different look. Now, at the top of the spectrum, you have industrials. Let me flip back to the presentation here for just a moment. So on the 1 year time frame, you've got financials that are outperforming. Next, you've got discretionary, okay, which was retail. We saw that over the 6 month time frame. If you look over the 3-month time frame, it's the XLI. The XLI has actually outperformed over the course of 3 months, right? So I'm just trying to show you how all three of these align very well within the course of the last year. Back to the chart. And then you look at the laggards and the underperformers. You've got XLU, you've got XLP, and then in blue, XLK, which that one's actually relatively interesting. But you can see that the defensive positions are the ones that are lagging here, okay, which that's an important topic to look at in just a moment. Let's shorten the time frame yet again. Let's go 1 month. All right, there it is. Now, at the top of the list, excuse me, we've got the XLB top dog. Okay, XLB has just made and this is especially here recently. If we dial that down to like the last couple of weeks, it's been a massive outperformance here. So XLB, you can see being the lime colored line out on top. So while the S&P is down about 1%, the XLB is up 2.5%, and that's a wide spread between even its next competitor, which is the XLI industrials, which that's the segment that we're just coming out of, which is up about 1.5% over that time frame, while those that are flat would be the XLK and then again the XLV. So on the shorter term time frame, what's recent? Where's the rotation taking place right now? Let's flip back over to our chart. And here we've got, again, stock market correlation. So as stock market rises, we started with financials outperforming, then we went to discretionary stocks outperforming, and then the XLI industrials outperforming, and then now we're seeing raw materials outperform. What I want you to take into consideration underneath all of these, so it's pretty cool to see these all line up, is it not? 1 year, 6 month, 3 month, and it's showing phases of where that money is circulating. Now we're in that phase where they're buying up raw materials and energy. All right, and what's happening underneath is that here the market. What is the market suggesting that we're doing as these stocks start to get noticed and start to get bought up? That means we're hitting a little bit of a peak, right? One of the reasons why when we start to head into corrective environments, one of the reasons I always stop to look at these stocks is I always want to know when the market starts to get defensive. And as of late, we haven't seen that yet. We haven't seen the market take on a really defensive tone. Now, I've been saying for the last little bit that we've got some pretty big headwinds coming into September. And not to mention we're seeing the big rotation into materials and energy stocks. Now this doesn't necessarily mean the market's going to top and we head into a bear market starting next month. The rotations here could last a month, 2 months, 3 months. It could last a little while. But if you're using sector rotation to determine when the market is starting to head into bear market territory or when the market is starting to tip, what should we be looking for? Where should the rotations be taking place? We start going into staples. We start seeing purchasing going on in defensive names. Healthcare is done okay just overall in general. Utilities, that's been more, the utilities play has been a lot more interest rate sensitive. But when you start to see over the course of a few weeks or a month that these guys start taking off again, staples, healthcare, utilities, XLP, XLV, XLU, when those start to outperform, that's when you start to worry about potential market corrections, bear markets, and things like that. Now remember, this bull market to bear market, we're looking at this on a very, very low time frame. I mean, I'm just surveying the rotation cycle just over the last year. The market hasn't been rallying for just the last year. But I think there is something to the last year specifically, and the reason why I chose that 1 year duration is because of this, because of the emotion and the psychology that's taken place in the markets over the last few years. So Optimism, excitement, thrill, euphoria turns to anxiety, turns into denial, to fear, to desperation, to panic, to capitulation, despondency, depression, hope, relief, optimism. Okay? And the thought process, and this is, we talked a little bit about this, about average Joe, right? Average Joe really gets going in the thrill of the market. Wow, I feel great about this environment, and this is a great investment. And then the market starts to roll over, and then all of a sudden he's in denial. Temporary setback, I'm going to let this trade turn it into an investment, and then markets really start to come in. Maybe the markets just aren't for me. And at that point, when you can sense capitulation, we use the ITB, the housing stocks, as an example on Wednesday. Because there was a lot of average Joes capitulating and selling home builders on Wednesday, we came back and said this is a maximum buy opportunity. We said that Wednesday night coming into Thursday. Watch the ITB, and in particular, KB Homes and Beazer, HOV. Sure enough, the stocks that have rallied the most in the last 2 days are the locations where the market has sniffed out that point of maximum financial opportunity. Patrick, yeah, so the next chart that I'm looking at is that sentiment chart here as well. And so, during those times of enthusiasm, when the market starts to see that blow-off move and that, panic buying phase when everybody jumps back in. And, this year in particular, we've seen some really good mutual fund inflow data. And there's a lot to that, because there's, with what's going on in the Treasury market and the fact that the market's at all-time highs, there's that shift that's going on here that makes people realize that, hey, there is opportunity in stocks. And so it's that, we've been in that returning confidence phase in the market for a while. 2011 was, I think, a kind of a starting point for the markets. That would basically be the aversion phase, right? So if we're looking at a 5-year chart of the S&P, here it's obvious we have 2007. Here it's obvious we have 2008. We have the 2009 lows, and then we have the wall of worry. And that lasted till 2010, and I would say that right here, anxiety phase was the start of 2011. And this was about mid-2011. That's an ugly 2, but mid-2011, and this is the end of 2011. This was the year that just completely killed the retail investor. Started off up here, washed them all out, stopped them all out down at the lows, and rallied right back up to the highs without him. In fact, if you guys remember 2011, the S&P closed at the exact same price that it opened. Doug Cass made that call, that we would see a flat year, and how remarkable that really truly would be, like literally a flat year, and how that's only happened like 3 times in the history of markets, that you literally have a flat year. It was an amazing call. But I think investors, like Doug Cass, or we talked about Carl Icahn and his Apple purchase, I think that they understand this, as all good traders do. And I think he knew that we were setting up for something like this, where you've got a few people to slowly come back into the market. The market's going to rinse them out and rip right back up, and leave them all out of the market frustrated and rally back to the highs without them. So in hindsight, I can see exactly how that call was made. Makes perfect sense. And then here we've got 2012 to 2013. We're sort of in that returning confidence mode. And remember, this is what returning confidence eventually looks like before you get one of these, to where a topping process starts to happen. It's like the ITB. You happen here, and then kind of a reversal pattern that sets up a breakdown, and then whoosh. So sentiment plays a really important role here as well. And why I chose the last year is because I think it highlights that ever since we basically had the fresh start in the returning confidence cycle in stocks, I mean, I truly think that the bull market really started in 2011. You know, some can go back and say, well, in 2009 is where the bull market started, but I don't like to include this phase in here because I still think that that's tricky enough to where it's, you know, if you've participated in the market, I still think that these right here, the wall of worry, are still bear market rallies. And to me, and this is just my own personal opinion, but the actual bull is confirmed here when prices retrace and they don't go back out to take out these lows. So the fact that the S&P came in as low as it did and didn't come out to take out that 666 low was, in my opinion, kind of the start of the longer term, more secular bull. Why that's important, it's important to know how the thought process is, and so you can recognize opportunity, but you can also recognize where, you know, where traders are getting into the market, and then try to align that with a, you know, with a standard business cycle or sector rotation flow. Moving right along, this I think is the most important chart of them all, because there's not a tremendous amount of investors left after what's gone on in the last 5 years. I used to be an investor until 2007, and I've tried to slowly get back into that. It's easier said than done. You know, I think 2008, 9, 2011 changed, you know, people's thought process about the buy and hold. And that's why, you know, from a generational perspective, we've lost a considerable amount of market participants. You know, they don't believe in it anymore. So here's what happens. So I'm looking at stock rotation and stock market cycle. Okay, so now I'm talking about if you can identify where the market is going to rotate into a particular sector, into a particular group, you've got to know what's the pecking order for individual stocks. And I try to talk about this a lot, you know, as we go through the stock selection process. And I say, okay, well, this is why I'm picking this stock as opposed to this one, is because, you know, the structure suggests it's got more upside opportunity, but plus, if it's early in the rotation, if it's fresh, you know, brand new, just starting, you're going to see investors dip their toe into quality first. Because if at any point you're ever uncertain, you always go quality, because quality is going to hold up better. And when I say quality, I'm talking blue chip, I'm talking you know, dividend paying, great fundamentals, just, you know, sector or market leader in terms of quality. The same can be said for corrections too. Right when you hit that level of the maximum amount of financial opportunity, the bulls, those, you know, those that are coming in to buy the feel of depression in the market, they're doing so with the best stocks first. And that might last for a couple of days just to get the initial bump. And as they see that those stocks are sticking, then they quickly start to, you know, lighten up in the quality and take on more risk. And so the next phase of a stock rotation is going to be momentum stocks. So if we're talking, let me think of a good example here. Let's do something just as simple as semiconductors. I'm just going to go into the group here right now, and I'm going to look for stocks that trade over 1 million shares. This is going to reduce the list significantly. And let's see, there's a couple of solars in here, so let's go to charts. So if you were going to define quality here, I would say probably ATML. I would say Intel. And then as you get to more riskier investments, I would say something like ON, Semiconductor, or SPRD, would be a little bit lower quality, MXIM, just as examples. Whoops, wrong slide. There we go. So if they're going to go quality first, you would see stocks like AMD, Intel getting purchased off the lows. Then when you get into momentum names, those are going to be the stocks that generally are, once they start rolling, they start moving a lot faster. I like to think of momentum stocks as, on the grid that I'm always pinned on every day in the webinar. Your Apples, Amazons, Baidu's, Google's, Netflix, Pricelines. Those are what I consider to be momentum stocks. When those stocks get into a trend, they just trend for 3 months. And so that's why we get stuck on those for long periods of time, is when the market's in, just straight trend mode, these stocks just offer opportunity every single day. Next, you'll have the laggards. And so when I say laggards, the one that jumps out to me would be Maxim, MXIM, because that stock is going to stay down near at its lows. So basically, when you've picked all the quality and when you've picked all the faster momentum names, now you start looking at, okay, well, I really still do like this group. The next thing that's going to keep it up and moving is if we rotate out of the stuff that we've got the best profits in, which is quality and momentum, and then we start buying the laggards. Buying the stocks that haven't participated yet, but the group has been thriving, it's been flourishing, and just based on the fact that a rising tide lifts all ships, I'm going to go get into the laggards because they should be bought up here as well, because this is a rotation. And so the laggards are usually kind of mid-cycle here, and that's anytime you can see the laggards that start moving, then you know kind of where you are. That's always a confirmation that laggards outperform, so that you can start going into the final risk phase, which is high risk. We do the same thing with the market in general. This is why we watch intraday and daily and weekly correlations between the Dow and S&P versus the NASDAQ and the Russell. Because if the Russell and the NASDAQ are leading in terms of performance, that means we're still in high risk mode. That means risk appetite is high. That's a good confirmation of a really bullish trend, and that means that we're looking for dip buys, looking for dip buys, looking for dip buys over and over and over again. So the final stages of the risk appetite, let's call this the risk appetite index. You get into the short squeeze. And those are going to be the stocks that have got the significant short positions. And remember, shorts are smart. They're sophisticated. They are able to endure a lot of pain. I gave a presentation last night through Scottrade, and I went through four of my favorite examples of a short squeeze. Obviously, Herbalife is one that comes to mind here this year. So is Tesla. Tesla's a great one, percentage-wise. But I even got into the conversation. We were looking at stocks like USU. You guys have seen that stock, right? How a low floater can go, a $3 stock can go to $30 over the course of 2 to 3 weeks. Talked about the short interest in the materials space right now, and how pretty soon you're seeing some of the quality names in the materials start to perk up. Cleveland Cliffs was a perfect example of that that's gone on recently. Let's clear the... If you look at CLF in relation to a lot of the material stocks, it really didn't go too far down beneath its lows. In relation to some of its competitors on the year, it's not down nearly as much, and the stock just had a great steady climb, and now it's getting even faster the higher that it goes. So you can see where some of the quality names have already started to lead. They're starting to move, and you can still see separation in the group. I mean, if you were to go to, let's say like Walter Energy, and then do some comparisons against BTU, and do some comparisons against ACI. This will be a pretty interesting group to watch here going forward. Is once the initial rotation happens, this will be one that you can watch in real time. So quality names go first, momentum names will pop up second. Now you start looking for the short squeeze and finding out, okay, well, where are the greatest number of shorts out in the material space, which we could just would be a simple scan. let's go screener. Let's go sector, basic materials. Let's go average volume. And let's go float short. Let's go over 25%. Oh, that's just under 25%. My fault. I couldn't see over 25%. So in all of those groups right now, or in all of the different industries within basic materials, which this also lumps in energy as well, these are the top 12 that are have the greatest short positions out there. Better than 25% of your outstanding float is short. This is why we've been talking about AK Steel. This is why I was buying CLF 3 weeks ago. This is why I had that position in END. You guys had, a few of you had kind of coaxed me into buying that stock back down in the 3s. And now that stock's all the way up to 5. On the refiner side, IOC, one of the reasons why I still like Molycorp and occasionally try to buy it is because look how fast those rallies are. Super easy to make money in there. Magnum, we've been talking about MHR here recently, is one of probably my favorite smaller cap oil names out there. Sanchez, USU, I mean, there's the example we were just talking about it a minute ago. The stock that went from $3 to 30 over the course of 3 weeks with a tremendous amount of volume, that's short covering. Walt Energy, that's why I've got a position on in there, and US Steel, still greater than 25%. So naturally you're going to scare some shorts with the type of rally that we've seen in some of these names right now, but it's also important to know, the quality names pick up first, momentum carries, laggards get bought, and then the short squeeze happens. And remember, the short squeeze, we're talking Tesla. Tesla goes from 40 to 160. We're talking Sears back in November of 2011, where the stock is trading at 80, has a horrible announcement, potential bankruptcy news, drops to 25 before Eddie Lampert goes out and buys 5 million shares and squeezes the shorts all the way right back up to 80. Just rips them apart. So those kind of movements we're talking about. We're talking about where $13, $15 stocks become 25 and 30. And remember, all these stocks have that capability when you look at the structure of their volume profiles. It's all very possible. And then last but not least, yeah, Netflix did that in from 2009 on up to 2011. Same thing. Netflix was the fourth example that we did, because there was a monster short position that we tracked in that thing back in 2008, 2009. And what's crazy is the higher that thing went, the shorts actually grew. And eventually they were right, but they had to endure an insufferable amount of pain to finally generate that profit. So, and then the last stage of a market move or a sector rotation is what I call the floaters, because I couldn't think of a politically correct word to describe these stocks. But they are of the lowest quality. It's the crappiest, worst stocks in the group finally start flying. So you guys know exactly, Mike. Well said. The ones that are the less than $10 stocks, those are the stocks that move 50%, 30% in a couple of days. Those are the stocks that generate option-like returns in over short spaces of time. Call those the floaters. When you can see that the stuff that's leading the market is of the worst variety, and we've seen this over and over again. Every time we start buying those types of stocks, we're usually close to a peak before the market gets ready to roll over. So, and then on the way down, I only put two cycles on the way down, because to be quite honest, when you're buying against the market correction, it totally varies. You're going to get the super fast rallies, but one week it's going to be in momentum stocks, the next week it's going to be in laggards, the next it's going to be a short covering rally. There I've seen no super high correlation. During the correction, I think it varies on the individual setup. And then once you see that the quality names start going, once the Dow starts outperforming again, holding up a little bit better, maybe it doesn't go down as much as everything else, that's when you know that people are starting to rotate back into quality names again, and then the risk appetite index starts over. So that's the gist of how overall sector rotation and then stock rotation works. If you have questions, feel free to submit them. One rotation that we have talked about that Ron mentioned earlier is, you take REITs as an example, and look at how the IYR has done. Actually, I'm going to do this a little bit differently. Whoops. I don't mean to go 10-year, I meant to go 5. All right, so there was a point when the IYR really started to outperform, and really it did well. It did pretty well, hanging with the overall market. But there was that point, especially in the last couple of years, where the REITs really started to kind of escalate their climb, and a lot of that centers around the idea of interest rates and where can an investor find yield. In fact, that was one of the things that Eric and I were talking about a lot in 2011, is that there's a global search for yield right now, and it is nowhere. You can't get it in high dividend paying stocks because those are getting flushed. You can't, really was nowhere to be found. You could not generate yield. And the market was in kind of tumultuous times, so that was the year where it was so extremely difficult to make money. Like I've told you guys on many occasions, if you traded through 2011, you are now prepared for anything that the market's going to throw at you. Because if anybody made money that year, they should be awarded a medal. But that relationship's been kind of flipped on its head lately. And if you look at what is replaced here recently, it's groups that do particularly well when interest rates are potentially going to rise. Take a look at this chart, the broker-dealer index. So the broker-dealer index has been a laggard for several reasons. Most importantly, because the retail trader's not out there opening up online accounts, they're not out there generating commissions, and trading just as a business and a pastime is dead. If you're still left here, you're one of few. But here this year, it's broken out. I mean, here's 2008, 2009 lows, and the XBD in late 2011, and then again in mid 2012, while the market was doing really well, was still very, very close in proximity to its 08, 09 lows. It was amazing. And if you look at something like Charles Schwab has not even taken out its highs. I have to go a little bit further back. Whoops. It's not even anywhere close to its 07, 2008 highs. Most stocks have just completely blown those out of the water. If you look at Interactive Brokers has stayed down near its 08, 09 lows for 5 years. If you look at E-Trade, same thing, just hovering down near these lows. But now lately they're starting to pick up again, and that's because these guys have a considerable amount of assets, and if interest rates are low, they're not really earning. One of the places where they make considerable money is interest on assets that they're holding. And so if the play here is that interest rates are going to rise, well, then you're going to see less excitement to hold REITs, because people hold real estate investment trusts with considerable risk that they're such volatile instruments. But if there's yield to be found elsewhere outside of that, then they're going to start to disperse from that play and start heading back into online brokers. Insurance companies, like if you look at Hartford, they've been perking up here recently and are now trading up against, here's the lows from 08, 09, but the stocks like HIG topped out in 2009. HIG has never gone to take out those 2009 highs, and here we are just slowly creeping above them right now. So insurance company plays like the Hartford, like Allstate, like pick your pick your name, that's going to be the next trend that lasts for probably the next couple of years. And yeah, Mike, let's look at that. Let's look at that IYR. Here we see sentiment, returning confidence, denial. Here we've got the panic stage. Looks like we're heading into discouragement phase right now. And then once we trip out that low, then you're probably going to see the wall of worry rally. You're going to see denial. You're going to see aversion, and then you're going to see returning confidence again. And that's how the nature of corrections are all pretty much the same. And if you understand the thought process there, it helps give you an edge of avoiding reacting like the average Joe investor. All right, so anybody have any questions so far? Hopefully this just helped to kind of define how the overall process works. Hopefully it's gone to show you where we are right now and what stocks have done in the last year. I mean, in the last year we've followed this stock market phase to a T. 1 year outperformance, financials. 6-month outperformance, discretionaries. 3-month outperformance, industrials. 1 month outperformance, materials. And materials and energy are usually right around a high. So what you have to watch for now, and this, like I said, this could last a month, 2 months, 3 months. 3 months has kind of been the phase between each of these. And then from that point, staples, healthcare, utilities. Like if you were to ask me what I think for next year, I think next year markets will top early, and I think they'll be under pressure for most of the year, meaning the high that we set in the first or second quarter of next year probably doesn't get touched for the remainder of the year. Bigger picture, that's okay. Long-term sentiment cycle, that's kind of more like a buy the dip phase. All right, so it doesn't look like there's too many follow-up questions there, so thank you guys for participating.